Happy holidays today, everybody. I've been spending quite a bit of time today looking at different market scenarios, and what I want to focus on here is something a little different than probably what everyone else is looking at in terms of when the bounce is going to be, or if we're going to have a tough market for a few years, things like that, and look at what headlines matter, which ones don't. There's a lot of headlines right now in the market that could move us from the resolution to the trade war to some sort of a government shutdown deal. The Federal Reserve could back off interest rates. We could get some kind of a bipartisan infrastructure deal. There's a lot of things. And I think the only thing that really matters is liquidity. And what that means is the direction of all the central banks in the world and where they're going. And in the last 8 or 10 years, you've seen a European central bank, the Japanese central bank, and the Federal Reserve backstopping the market, printing money, buying bonds, buying assets. And it's been talked about everywhere pretty much, but the amount of relative stimulus applied in 2008 was about 8 times more than the Great Depression. And then you saw the incredible results of that with these rallies and everything from real estate to pretty much every asset, marijuana to the Bitcoin bubble, the stock market. And I don't think the market just falls off the face of the earth because we don't have some kind of a systematic disaster going on like we did in 2008 with all the bad loans, or we did in 2000 with the tech stocks becoming so wildly overvalued. I don't think the situation is like that. But what is happening right now is everyone's very comfortable and has seemed to bought into this idea that passive index investing and stock markets in America are just going to go up on a straight line forever, and there's never going to be a 10-year period where you don't make money. And historically, that's just not the case, even though people like to quote 8 or 10% return over 200 years or whatever it's been. There's been 50 or 60-year periods where you didn't make money. And I'm not suggesting that happens right now, but that's more likely than people think, probably. That's really outside of the time frame that I trade in. But my point of all this is that the liquidity headlines are what are really going to drive the market. So the Federal Reserve pulling back would be a lot better reason to rally and hold that rally, in my opinion, than a trade deal with China or some kind of a bipartisan infrastructure deal or government shutdown averted and things like that. Those other deals, those things are more reasons for me to get out of positions I don't like and short the market on big rallies. If the Federal Reserve changes tune, I don't think that necessarily saves the market, but I think that's a lot bigger deal than the other ones are, because the other stuff is really just noise. The deals with Mexico and Canada, the North Korea nuclear deal, China trade war, it's all really just noise around liquidity. And the market has climbed the wall of worry so much the last however many years because you've had such low rates and you've had friendly central banks around the world. And now that that's changing, and even in Japan it's changing, where they've been as dovish as anybody. And when that's changing, it doesn't mean that the market's going to fall 50% necessarily, because they're not stupid. They're not going to pull the rug. But when you see the Federal Reserve get a little bit more aggressive than the Yellen or the Bernanke Federal Reserve was, that kind of tips the hand a little bit of they're not going to be as kind to the market. And it might be politically infeasible to continue the same policies they've had, especially when the government is running large deficits. So you're getting into a situation where the market is, of course, going to have big short covering rallies and things like that, but they need to be able to orchestrate some kind of a soft landing in terms of pulling back, but not pulling back too much. And hopefully assets have corrected enough where we can sustain some kind of normal business cycle in the face of pulling back the medicine that the patient has been given the last 10 years. And that's something that has never really been done before. We've never had this situation where we've had this much stimulus that's gone into the economy, not just in the US, but globally. So it's going to be really interesting to see how they exit this. And I think right now you're getting that shock off the highs because of the feeling that, oh shit, they're pulling back. And they're doing it a lot more aggressively than the market thought with the lack of a dovish hike at the last Fed meeting. So now, do they back down again in the future? Do Europe and Japan change their tune? I know China is already stimulating, so that's one positive thing. But I think that if you're going to watch something, that's the most important thing to watch. And these things work with a lag. So I think a lot of the pain has probably already been into the market for the recent moves we've seen from the Fed. But going forward, if they're hell-bent on getting this liquidity out of the market as the economy is on decent footing, asset prices are going to struggle. It's hard to figure out what asset prices are worth when all the valuations seem to be stretched by historical norms based on policies that are not going to be had going forward. So for us who are trading shorter term and don't necessarily give a shit about all of that, but want to know it for context, my point in saying all this is to know that that's the backdrop of what we face. And the other stuff, the trade war and the bipartisan agreements and things like that, they don't matter as much to me because I don't think ultimately they matter to the market. So figuring out getting ahead of this liquidity game is going to be the best thing to do. So if we get huge rallies and that induces the Fed and the ECB and Japan to keep pulling this stuff out of the economy, I think you're going to continue to see things struggle until we get to some sort of a stopping point. And I don't know if they're going to push it until it breaks. I don't think that's anybody's intention, but I don't think that they know enough to figure out when that is, as evidenced by the last Federal Reserve meeting when the market was calling for them to pull back and they didn't. So to me, those are the headlines that we have to be paying attention to, and those are the stories we need to be watching. So it's about finding good technicals, using the same indicators and sentiment things and trading strategies you always use, but paying attention to the real thing that matters, which is the liquidity and how they're going to deal with that. And it's not just a U.S. thing. It's an everywhere thing. And however that plays out, I think is going to give us a good roadmap for going forward. I think it's definitely possible that they can orchestrate something that soothes the market and we can have a little bit more stability, and no one wants to see everything come crashing down. But again, it's really hard to predict when we've never done this before. So rallies to sell stocks that you don't like, rallies to sell call options and collect premium, things like that. Or if you're buying, looking for things that are pushing the market down that may not be related to what really matters. More, tightening of the screws in the trade war, a longer government shutdown, things like that, in my mind, are less important and will eventually get resolved. And those are things that the market's going to recover from. But if we keep pulling liquidity out of the market, that's going to cause, I think, my intuition is that we're going to have a little bit more of a painful, grinding negative market this time than we've seen in the past with these quick turnarounds. It doesn't mean there's not going to be great tradable rallies. We're probably getting closer to one now, but we've had a 10-year run and things are changing. The policies that caused that are changing. So if that happens, then you have to ask yourself, well, what does the market do? And the market's always looking down the road. So if the economic data continues to stay good, they're probably going to keep removing the stimulus, which eventually is going to mean that the data is going to soften. And the market obviously knows this. So it's this game of we're always trying to trade tomorrow's newspaper, next week, next month's newspaper, and getting ahead of these events. So that's what I'm looking for in terms of getting ahead of the events. And as these big events come from the central banks, figuring out what's the market doing, what do they expect, and then do the markets act the way we think they should? So right now, the dollar has been rallying strong. Federal Reserve was hawkish on rates, which should be bullish for the dollar, but the dollar is kind of hesitating right now, and it's going a little bit lower. And that's very notable to me because that means that the market may be pricing in that the Federal Reserve made a policy mistake or that data is going to slow and they're going to need to back off and reverse course. And those events are important because if the market thinks that, then you're going to get a different response than you would expect, which creates big moves and things that we can trade on. So you watch things like, can gold rally now? It should be supportive for oil down here. If the dollar gets weak, should be supportive for commodities. Is it? I mean, does it work that way? Those are the things to watch. So that's where my mind is right now. And I have a bunch of scenarios written out for this week in terms of if we do head down a lot more, thinking about tax loss selling. So people who own oil names, and let me think what else has not done well this year. Tech has done well. So if you own tech, you've probably, if you didn't like the market, you got out of your tech, booked your profits, and then you had to look for where can I offset those profits against losses to pay less taxes. Well, oil has been shitty all year. So oil stocks, and you can see that, are getting sold just into a crazy extreme right now. So those stocks are probably a victim of tax loss harvesting to offset the tech gains. You might have gotten a little bit of that in crypto. You Probably are getting some of it in banking and financial stocks, tobacco stocks potentially. And I think that could create opportunities in the new year if you're interested in those names and you understand some of them, to look at selling that may have gone a lot further than makes fundamental sense. So that's something on my mind for tomorrow, to kind of take a look at that. Apple has come off almost 35%, I think, in a couple months, which is a pretty extreme move for a company that big. There's individual stories there about slowing phone demand and things like that, but that's a good stock to watch for the overall market direction. Things like Nvidia, Amazon, Square, the popular names that the public got sucked into, watching those at their key areas, 200-week moving averages, 50-month moving averages, things like that, retesting 10-month moving averages to sell against, things that not everybody's looking at. I'll have that on my mind. The bond market is important. We saw a huge rise in short-end yields before the market went down. You often see the bond market move in front of the stock market. An aggressive move in yields is never a good thing for the stock market when they're going higher. And it doesn't correlate exactly, but it does correlate over time. And I think that leads me back to commodities. Commodities could have a period of outperformance if the market continues to struggle. Historically, commodities have done well when the market struggles, but the timing is fuzzy. That's something to look at. If you're worried about emerging markets, those have gone down way more than the U.S. has. They probably also have less going for them at times than the U.S., but maybe that's not the case anymore. I think the dollar, again, is important to watch, with the deficit being relatively higher than it's been before. After good times, you sometimes have a surplus, and right now you're not seeing that. You're seeing a deficit. So if the recession comes again, you're going to have a way bigger deficit than we normally have in a recession, which is going to put us in a situation where people are going to start to look at the news and panic about the dollar. So then I'm thinking ahead, okay, is that when gold does well, when Bitcoin does well, when everyone's worried about the dollar? So that's a story that I'm trying to get ahead of and think about now. It's not showing up in the media yet, but I'm sure it'll be talked about. Thinking what else here? Dividend stocks, I think, are something that were very popular as there's a lot more baby boomers and they want to chase dividend stocks. So a lot of people are buying dividend stocks that may have unsafe dividends. Tobacco's gotten killed. I'm not saying the dividends are unsafe, but I've noticed that. I've noticed AT&T, obviously General Electric, IBM, companies that are taking on a ton of debt and struggling with growth, but pay good dividends. Ford, getting companies, again, not growing, paying huge dividends. Legacy companies are getting killed right now. Probably going to have to cut those dividends. When somebody cuts a dividend, it's often a really good time to buy the stock because they're focusing on cash flow and they sell the stock off pretty hard when the dividend gets cut. So sometimes that's a nice short-term trading opportunity if you wanted to buy some of those things. Yeah, that's what's on my mind now. I'm sure there's more, and I can come back on and talk later if I think of it, but those are the things on my mind now.